Hi, what's up, guys? I'm Evan. Today, I would like to share something about market value ratios to you. Assume that you find that there is an amazing car, but it may not be enough to justify you to get one, as cost is as important as the value of a product. Therefore, when we make decision, we will try to get the best option by balancing the cost and performance. The same rule can apply when we are looking for good investment. We are not only looking for good company, but also looking for good timing to get it at a cheap price. And one of the best indicator would be the market value ratios. So what makes the difference between market value ratios and other accounting ratios? Accounting ratio can roughly categorize into four types, namely profitability, efficiency, liquidity, and debt ratio. Their main difference is that they do not take into account of the current market price. Therefore, they focus mainly on evaluating the quality of a company rather than on the worthiness of a stock. In contrast, market value ratios focus on the value of a stock. Therefore, even other accounting ratios indicate that a company is not that good, but when its stock price is already overreact on the downside, the stock can still be a good investment for investors. And today, I would like to introduce two market value ratios to you. The first is the price earnings ratio. When we divide the stock price by earning per share, we can get a P ratio. And let's say when the stock price is $12 and the earning per share is $1.50, then we can find the P ratio is 8. So P ratio of 8 means that when earning per share is constant over time, investor can get back their initial investment in 8 years. And this formula tells us that when other things being equal, stock is more attractive when P ratio is low. So it means that we can spend less in getting the same amount of earning. There are a lot of websites providing us companies P ratio such as Yahoo and investing.com, but sometimes their figures are not the same. The reason is that they employ different earning per share in calculating the P ratio. You can see that the earning per share used by Yahoo is higher than that by investing.com. So it helps us to explain why the P ratio provided by the Yahoo is much lower. But how to solve this problem is another story, and I will try to get back this point in the future. So let's say we agree that the P ratio is 15.49, but then is it high or low? Then we need a benchmark to make the comparison. As operating model is different across industries, ratio analysis is only meaningful when we compare ratios with companies in the same industry. Let's say we got the P ratio for 4 restaurants. Which one should we pick? The quick answer could be Fairwood, right? As it has the lowest P ratio. But if it's the way to make money, would it be too good to be true? The reason that we cannot use P ratio alone in making investment decision is that there are many factors making the P ratio up and down. So for example, companies with better growth potential would definitely deserve higher valuation, leading to a higher P ratio. And in addition, for companies with higher operating risk, holding earnings are the same, they should have a lower stock valuation as they are risky, and eventually resulting in a lower P ratio. So please try to ask yourself, when you find some companies has such an incredible low P ratio, and then you better to use other information before you make the final decision. And another way for us to use the P ratio is to find the turning point in the market. P ratio usually rise in a bull market and drop in a bear market. So by calculating the historical FHP ratio, we can regard the time that the P ratio is substantially higher than the FH as the time to sell, because it may mean that the stock price is over. Or If the P/E ratio is substantially lower than the average, it means that those stocks may be underpriced, then it's a good time for us to buy. So using 2008 financial crisis as an example, it seems that this method is quite good in capturing the top in 2007 and the bottom in 2009. But then you may want to ask, how to define substantial? So, example, the P ratio was actually quite high in 2004, but afterwards, Hang Seng Index kept increasing by more than 100% until 2007. And in contrast, the P ratios were not that high in 2018, but then Hang Seng Index fall by 30%. Therefore, we need to combine P ratio with other macroeconomic analysis to draw the final conclusion. Next, I would like to talk about PB ratio. PB ratio equal to the stock price divided by book value per share. And let's say if stock price is 12 and the book value per share is 10, then we can get a PB ratio of 1.2. Some people think that buying stock with PB ratio larger than 1 is not wise because we are actually paying more than $1 to getting something worth only $1. But I would say that it's hard to judge in this way. As stock price does not only reflect book value, it can also reflect growth potential and corporate governance that are hardly to be captured by book value. So we cannot use PB ratio to to make decision without any benchmark. So how can we get a benchmark? Like PE ratio, when we make comparison, we need to find a company in the same industry to make the comparison meaningful. So let's say we have 4 companies here. So based on PB ratio, which one will you pick? The quick answer could be Swire, as it has the lowest PB ratio, so that we can only need to pay 0.42 to get assets that worth $1. But we always need to bear in mind, is it too good to be true? Many factors can lead to the variation in PB ratio. For example, it could be due to the difference in real value and the book value, and it can also be caused by the higher operating cost. Like PE ratio, PB ratio cannot be used alone in making investment decision. So in sum, I hope you understand that we cannot use P ratio or PB ratio as a trading rule. So buy those low and then sell those high. But instead, we need to start from fundamental analysis by finding out those good companies, and then we use the P ratio as an indicator to pick the best timing to trade. Now let's summarize what we have talked about today. First, there's a difference between the market valuation and other accounting ratios. Second, how we can apply P ratio and PB ratio in investment. And third, how to conduct PAU comparison. And at last, we mentioned the limitation and the success rate to use them in investment. I hope you enjoyed the video. So if you like my video, remember to like and then subscribe my video. I'm Edwin. Thank you so much for watching and see you next time. Bye.